Over the last 2 years, the top seven stocks in the stock market have done fantastic. They've been magnificent in 2023, 2024, and those returns were just exceptional. I currently own three of the top seven stocks, and especially Meta has been a terrific stock to own. But are they going to be terrific for 2025? That's what I hope to answer for each stock that is in the top seven stocks in the stock market. I'll take a look at each company and always value the company based on the free cash flow forecast that I've put together for each company. I'll take a look at the health of the business. What momentum do they have? What hazards and issues are going to come up in 2025 that can hold these companies back? In essence, I want to know which stocks I should own in 2025 to beat the S&P, to have a very good rate of return. Good returns, good appreciation in 2025 has been elusive. The S&P is down year to date. The Nasdaq is down even further year to date. So investors have to be smart in picking the right companies that are going to perform this year and next year. So let's go through each company. I will value each company based on free cash flows, and I'll share with you my point of view on each company and let you know what I plan to do with each one of these top seven stocks. So the top seven stocks are Apple, Microsoft, Nvidia, Amazon, Google, Meta, and a new player, Berkshire Hathaway. They have appreciated so much, they are now one of the top seven stocks. And the very top of the Magnificent Seven haven't been all that successful. Year to date, Apple's down 12.84%, Microsoft's down 7%, Nvidia is down 12.35%, Amazon's down 10.5%, and Google is down 13.3%. Google being the worst performer out of the top seven stocks. Meta is showing positive appreciation in 2025, and Berkshire has really stolen the show. They've appreciated the most out of the top seven stocks. Now, as I look at the top seven stocks, they represent over 31% of the overall value of the S&P. So you could see that they still are a big part of the S&P's performance. Not too long ago, when really these stocks were at their height, this measure was closer to 37%. So we're seeing an outflow of capital out of these big stocks. That capital is going elsewhere, smaller caps, other sectors, even foreign markets. You're seeing China and some parts of Europe really perform well. This is healthy. It's healthy to see that high, expensive stocks are having less investment. In fact, investors are pulling out of those stocks and going where the valuations are better. So that is healthy in my mind. Just a quick run through price to sales on these companies. I like to be under 10. And the ones highlighted in red are companies that have a price to sales above 10. One of them is Microsoft, the other is Nvidia. Nvidia probably being the highest risk. That's a really high price to sales. Berkshire being the lowest. They have a really low price to sales, but Berkshire is kind of a different company. It's almost like an ETF. It owns many different companies and it doesn't have one core business behind it. So let's take a look at Apple first, and I'll give you a quick run through of the company and show you my valuation of the company. The Apple stock over the last 5 years has been excellent. It's up 280% in appreciation. That is just clearly an excellent performance. Investors did really well with Apple. It has become a $3.28 trillion market cap company, and its forward PE is 29. Analysts still like the company and think it's discounted by 11%. I have a differing viewpoint that I'll share in a minute. Overall, the Apple stock has a little been surprising to me because their revenue hasn't really grown a whole lot, yet their stock continues to appreciate. The revenue has been fairly flat for 2 years. It was actually negative, contracting revenue in 2023. And in 2024, it was only 2%. So that slow growth, to me, I don't quite understand how a stock can continue to appreciate so well when revenue is showing signs of trouble. Why can't Apple grow? Are their products not exciting enough? Are they getting old? Is the product portfolio not diversified enough? What's going to grow that top line revenue? I think that's the biggest risk behind Apple is where is the next catalyst to growth? And I don't think they've answered that question just yet. They've tried a few ideas that were not the greatest ideas. The Apple car is an example, not a great idea. They had the augmented virtual reality headset they came out with, very expensive headset. It didn't really sell many units. And now they're beginning to come out with a lower priced iPhone. And I think that shows that globally, they're having a tough time competing against the lower cost smartphone developers who are going to market with a really inexpensive phone. So they're really having to lower that price for their handheld, and that's going to shrink their margins. So overall, I think the Apple business is at risk. So I value companies like Apple using free cash flows, setting up a forecast of those free cash flows I expect from the company, and then discounting those future cash flows to today's value. And you could see why Apple is worth so much money is they produce over $100 billion of free cash flow. And that's tremendous free cash flow. I'm going to grow the free cash flow just a little bit, just expecting that they'll be more efficient. But again, I'm concerned about that top line revenue. And terminal value, I'll grow by 4%. The value of all those free cash flows is $2.2 trillion. I'll add cash and take away debt. I get to an equity value of Apple at $2.28 trillion. Their current market cap is $3.27 trillion. So they're actually being priced at a premium of 30% if I look at free cash flows. The earnings per share valuation is closer to fair value. It's being priced at a premium of 9%. Collectively, Apple is being priced 23% too high. And I continue to feel that way. I think Apple is beginning to see some outflows. And I would really focus on how are they going to grow? What's going to make Apple special in 2025, 2026? What's going to be the catalyst of growth? If there's no catalyst out there, this stock really is going to sell off by 30, 40% in price depreciation, in my opinion. Microsoft has also been an excellent stock for investors to have held for the last 5 years. It's up 184%, and it's a tremendous business. They are principally a software company, and they're in other aspects of technology as well. They have a valuation of 2.9 trillion, and their forward PE is 28. Analysts think it's a strong buy. We've seen a pretty good pullback in the stock in 2025. The revenue for Microsoft has been growing quite nicely at 15%, and they are a very large company. So that looks really good. Where things are troubled is in the free cash flow department. If you look at their free cash flow, due to the excessive CapEx, their cash flow actually contracted in the trailing 12 months. They're spending a lot of money, a lot of capital in the data center, trying to build out for what is expected AI is going to need. But there's been a market dislike to that strategy. And the Microsoft stock, Google, and Amazon have sold off. And I think Microsoft got the message. They have communicated that they're going to lease out versus build out their data centers. And I think that's going to help with CapEx, and their free cash flows will get back on track and begin to grow. That's positive news. Microsoft is an exceptional business. They've shown that they're growing. They're in the right parts of technology. Now, their cash flows are less than Apple's, but I expect they're going to grow nicely. The trailing 12 months, they're at $70 billion of free cash. And assuming they continue to really manage their CapEx, they're going to grow those cash flows over the next 4 years. And over the terminal value, grow at 4%. The value of all those free cash flows is $1.9 trillion. I add cash, take away debt, and the equity value of Microsoft, in my opinion, is $1.9 trillion. The market cap is really high at 2.9 trillion. So Microsoft, based on free cash flows, is priced 33% too high. When I look at earnings per share, it's closer to fair value. It's 6%. So combined, Microsoft is priced 24% too high. The pullback in Microsoft in 2025, I think, is a signal that this business was really favored by investors. And there's a lot to like with Microsoft. They are an exceptional company, very big and growing, but the price has just gotten too high. I think we need a strong correction or a stronger correction to Microsoft, have it pull back and bring that stock price down to either a fair value or a discount level. Going forward, if Microsoft can grow faster and really improve their cash flows, I think they could improve their valuation as well. But let's see how things play out in 2025 for Microsoft. Nvidia has been the top performer out of the Magnificent Seven stocks. It's up 2,188% over the 5 year. Incredible. But over the 1 year, things have gotten much flatter. And starting in June, if you look at from June 2024 to now, which is 9, 10 months away ago, the stock hasn't done anything. So I think it's really hit its top. And now investors are just waiting around to see what happens. The company is a $2.87 trillion market cap company. It has gotten as high as like 3.5, 3.6 trillion. It became the most valuable company in the stock market. It has the highest price to sales ratio, which is risky. Its current PE is 40, and it's supposed to drop to 26. We'll see if that happens. But 40 is also expensive. Analysts are still in love with Nvidia, but they could tell us all day long it's 48%. Investors are telling us something else. Investors are telling us that they're not putting money into Nvidia. They're afraid of what's going to happen. Nvidia is in a cyclical industry where things get built out and then you have a drop in demand. When that drop happens, revenues go down, profitability goes down, and so do stock prices. And I think that's going to happen this year or next. And once that's clear, this stock is really going to drop. The revenue for Nvidia has been incredible over the last really 18 months, just incredible growth in that data center. But as we look at the quarterly, the growth is slowing down from a percentage standpoint. And I think that percentage will continue to come down, come down, come down. And you can see that as recent as Q1 in 2024, they had a negative growth rate in quarter. And that's what I'm talking about, cyclical businesses, that it looks great. It looks incredible when it's on an uptrend. But once it hits that trough, once demand goes away, investors then feel like, oh my God, this thing's going to crash and burn, and they get out of the stock. We'll see if that happens. Along with the incredible revenue growth, this company has really risen its free cash flows, and I'll analyze that now. Now, I value Nvidia based on their free cash flows, and I put together the best forecast I can for free cash flows. I'm giving Nvidia every benefit of the doubt I can, and I'm taking their current cash flows and adding 20% as a starting point in year 1 and year 2. But as mentioned, this is a cyclical industry. The businesses that buy from Nvidia, if they keep buying at these rates, they'll be bankrupt. You're already seeing stocks like Microsoft, AWS, Amazon, and Google really go down in value because investors are seeing that CapEx and they don't like it. Well, those businesses are not going to continue to spend at those levels, and watch their stock plummet. All the CEOs will lose their job if that's the case because investors will be very angry. So Nvidia will see a lull in its business, and it'll begin to see a shrinkage of those free cash flows in year 3, year 4. Terminal value, I'll still give them the benefit of the doubt, and I'll grow it at 4%, even though it's a cyclical business. And they could see a long-term drought in their business if the data center is built out too much, and then there's excess capacity that takes 5, 10 years to really use up. The current value of all those free cash flows is $1.36 trillion. Add cash, take away debt, they get to $1.4 trillion of value for Nvidia. Market cap's $2.87 trillion. So it's a very high price for Nvidia. It's priced 51% too high compared to the free cash flows I expect from the company. When you look at earnings per share, it actually looks positive that, hey, earnings per share can support the stock price. Can't argue with that. But I don't invest principally on earnings per share, nor do the best investors out there. Read their books and you'll know what I mean. The blended value of Nvidia shows that the stock price is 31% too high when I blend earnings per share 1/3 and free cash flow 2/3. Nvidia has had a terrific rise. They've been the right company, right place, right time. But I think the story is going to end with a difficult next chapter. And I think you're already seeing investors not trading up the stock or not pushing the stock higher. The stock's really come down recently to really low lows. And more investors are shying away from Nvidia altogether, choosing instead to go into small caps and other sectors that are performing really well. So we'll see how Nvidia plays out, but it's definitely a stock that I would either sell or not buy or short. Amazon is just an incredible company. The things they've done are really incredible. They've built the biggest e-commerce business in the world. They're the biggest revenue company in the United States. They have a terrific cloud business. So all things from a business perspective, all the companies I've talked about are highly desirable businesses, but especially Amazon. And over the last 5 years, the stock has more than doubled in value. For the past year, the stock hasn't performed all that great. It's only up 10%. And of course, year to date, it's down more than 10%. And it's in correction territory. It's a $2 trillion market cap company, and their forward PE is 30, call it a 31. That is an expensive PE. Analysts really like the stock. I can see why. Although they're a huge company, they continue to have really good growth rates. 11% on that humongous number is really incredible. Now let's take a look at their cash flow forecast. Amazon produces really good free cash flows, but they have had a strategy of growing the business, being obsessed with the customer for the sake of just creating a more desirable business. I like that, but it's always come at either sacrificing profit and or free cash flow. So that's one thing to keep in mind around Amazon. Their free cash flows should grow really nicely over the next couple of years, but their cash flows also went down because they've been investing a lot in that data center. Their cash flow forecast for the first 4 years, I'm going to grow at 10%. And over the terminal value, I'm going to grow that by 5%, which is higher than the other companies. And I believe that Amazon's built such a large business that when they stop investing so much in the business, it's just going to be really profitable for a long time. They're going to drive cash flow at a much higher rate for a long time. So that's why I'm going with 5. The value of all those cash flows in today's net present value, 1.4 trillion. I'll add cash, take away debt, I get to 1.4 trillion. Now they're trading at a higher amount. So I actually believe that Amazon, based on free cash flows, is trading 31% too high. Earnings per share closer to fair value. But overall, Amazon is being priced 23% too high. Not the only one that feels that way. You saw the chart for the last year. The stock hasn't had really long-term appreciation runs. I think that the company's exceptional, but the fundamentals tell us that the stock is worth less. And I think investors follow that. I also follow it. I'm an Amazon stockholder, but I'm not buying additional shares. I'm not going to sell my shares. But if the stock were to continue to go down and get down to fair value, as an example, I'd probably buy shares of Amazon because I want to own this exceptional company. Google Alphabet has done a terrific job over the last 5 years. Their business is exceptional. Their search business is number one, YouTube business number one. They have a very good cloud business, and now they have an exciting robo-taxi business in Waymo. So just a lot of good things happening for Google Alphabet. The stock is up 210%. Over the past year, it's only up 11%. So you can see that these stocks have kind of hit a ceiling and are not going up with that trajectory any longer that they saw historically. This year, the stock's really given up a lot of gains. And this one out of the top 7 has lost the most. And that might be an opportunity. Let's take a closer look. It's a $2 trillion market cap company. Their forward P is only 18. Interesting. That seems a little discounted for such an exceptional company. The revenue continues to grow. Again, companies like Amazon, Microsoft, Google, to grow at these rates since they're so big is really incredible. Now let's take a look at their free cash flow. Google generates really good free cash flows, much higher than Amazon, as an example, right up there with Microsoft and almost as good as Apple. $77.8 billion is what I expect in the next 12 months. And I'm going to grow those free cash flows at 7% for the first 4 years and then 4% in terminal value. When I look at the net present value plus cash minus debt, all of that cash is worth $2.05 trillion, which is slightly higher than their current stock price and overall market cap. So Google Alphabet is fairly priced. The decrease in stock price has brought it down to a level that is a fair price. Earnings per share really show a lot of discount available in the stock if you evaluate the companies purely on earnings per share. When I combine the two and I take more weight in that free cash flow, 2/3 weight, 1/3 weight earnings per share, I get an 18% discount available on Google Alphabet. Google Alphabet is my second biggest value position in my portfolio. I really believe in the business. I'm a long-term stockholder. I'll continue to hold the shares, and I may be buying additional shares on any kind of pullback because I think Google is going to have brighter days ahead. And if we see any kind of pullback, let's say the stock sold off by another 10%, I just view it as a terrific opportunity to buy a very valuable business that would be trading below its intrinsic value. That's an excellent time to buy shares. Pat Dorsey really believes in that. That's where the buying happens, is when a company is trading below their intrinsic value. Meta has had a terrific 5-year run. The stock's almost up 300%, and it's become a $1.5 trillion market cap company, and it continues to grow their revenues really well. The forward PE doesn't look too bad, 23.5 for such a really good growing business. They're growing 22% on a very large number, very profitable company, has a really good strategy going forward. And I really like their Meta AI business. They have a couple of things that are new, that are exciting. They're also potentially going to create a new platform for short form videos, which is also exciting. So overall, Meta has been an excellent stock. It is the most valuable stock in my portfolio. I've seen it really rise nicely. Over the 1 year, it's done well, even though it's had a pretty good pullback over the last month. At one point in 2025, this stock was up 25% just in 1 month. Boy, was that fun to watch. But year to date, it's only up about 2%, which is still a win because the S&P is down in the negative territory. And as I've shown, most of its peers in the Magnificent Seven are down substantially. So Meta, when I look at their free cash flows and based on their growth rates, is a discounted stock. It's discounted collectively by 26%. The cash flow forecast looks great for Meta. Earnings per share looks exceptional. And if you think about momentum, Meta's really in a good spot. They are the most dominant player in social application platforms. They have those platforms growing and they're just huge cash cows. And they have new parts of the business like Meta AI that are really growing the overall company and could be a really strong catalyst for them to take over more marketing dollars from their customers. Overall, Meta is a stock that I'll be buying on pullbacks. It is the biggest position in my portfolio by a long shot. But at this point, I've seen the stock sold off to the point where I think it's a smart idea to buy into a stock below its intrinsic value that I truly believe in their strategy. And coming in at number 7 is the great Warren Buffett's company, Berkshire Hathaway. And if you look at their chart for the last 5 years, what a smooth upward trajectory chart. This is just such a well-run company by one of the greatest investors in history. Over the last year, it's done quite well. Year to date, it's beating all the other 7 stocks that are above $1 trillion and in the Magnificent Seven. It's a $1.3 trillion market cap company. Forward PE is 24.7. Now, this company I can't value based on free cash flows because the free cash flows don't come near the value of $1 trillion. So instead, what I wanted to do is show you what this investor owns, because Berkshire Hathaway is more of an ETF mutual fund. And when you're buying into Berkshire Hathaway, you're buying into a collection of businesses and a collection of holdings, for example, Apple. So let's take a look at what they hold and how that's performing year to date. So I've taken Berkshire Hathaway's portfolio and looked at the stock price each stock was trading at the beginning of the year and where that stock is trading today to see which stocks are really performing well within the Berkshire Hathaway portfolio. Of course, Apple is its biggest holding, and as covered earlier, that stock is not doing well. American Express, number two, biggest holding in value, and it's down 8.85. So Berkshire Hathaway's first three top positions are in the red. But when we get down to Coca-Cola, it's doing well this year, and it's a staple, and that's understandable. And then we've got Chevron. I also own Chevron. It's up 13.75. That's a big energy company. Occidental, I wanted to point out that, that's Occidental has received a lot of attention as a Berkshire investment. It's down 3%. Chubb is a stock that I own. It's up 5.48%. Kroger, another staple, I own that stock. It's up 6.95 as well. Amazon, which we covered a little earlier, it's down. And it's interesting that Berkshire owns Amazon. They may want to build a bigger position there. We'll see. And then down here, Citigroup is another stock that I own, and it's up 2.26%. New Holdings, interesting that they own New Holdings. It's up 11.87%. That's one of my holdings as well. And then I would just, for fun, wanted to point out they also invest in the Atlanta Braves, which is a baseball team. And the Atlanta Braves are publicly traded, and they're up almost 3%. So look at that. Overall, their portfolio is down 3.56%. The S&P is down about 3.64%. So they're pretty much at the S&P level of performance, right there with the S&P. Now, one observation I'll make is oftentimes I hear Warren Buffett, he has so much wisdom to share, but he's often said that, hey, if you're a long-term great investor, you should really concentrate your investments into a few companies. And as I look at this portfolio, they have a lot of companies. So they're really diversified. So it's in my book, I always listen to what people say, be respectful. And there's probably something there that I can learn. But to really tell me what they truly believe in, I watch behavior. I watch a person's feet. And if I look at the Berkshire portfolio with the many different companies they have, is that they want to own a piece of these exciting businesses, and they don't limit themselves to 5 or 10. They don't limit themselves just to a couple companies. And, hey, I've got a fair number of stocks that I own, and it's good to know that, hey, I'm not that all that different. Berkshire Hathaway also has a lot of positions in different companies. So I wanted to point that out because it is something that I've heard Warren Buffett say, that investors should try to be concentrated in a few stocks. But what he's actually doing is quite different. So that is Berkshire Hathaway, an excellent company, but their portfolio is down like the S&P while their stock has been rallying up. I think part of it is that the Berkshire name is such a trusted name. And now that stocks are selling off, investors are like, hey, I'm going to switch over to Warren Buffett because he knows what he's doing. And I'm going to try to avoid some risk. I think some of that's going on. I can understand that, but it's not based on valuations. All right. So just to recap, the 7 most valuable companies on the stock market, in my opinions, Apple, it's a sell for me. I just don't see how that business is going to thrive for the next couple of years. And I think it's priced 23% too high. Microsoft is a sell. I think they've been spending too much in capital in the data center, and I think their stock's priced too high. Nvidia, I think they're going to have a tough time for the next 2 years. It's a sell for me, and I think their stock is priced 31% too high. Amazon is a hold. I think that the current valuation is much lower, but I think it's temporary. As they stop spending so much in that data center, their fundamentals will get better. Google is a buy. I think it provides a nice discount and is a good stock for me to buy on pullbacks. Meta, ditto. It's a buy. I'm buying on pullbacks. And Berkshire, I would label as a hold. I think a lot of people are going there for the sense of security, safety. But as I saw in their portfolio, they're not beating the S&P. They're right there with the S&P. And their Apple stake, I just don't believe in. So we'll see how things perform for Berkshire. It would just be a hold for me. So that's my review of the Magnificent Seven stocks. We'll see how these play out. But for now, I'm going to be really focused on Meta, Google as my buys, and I'm just going to hold my Amazon stock. And I'll be watching the others to see what happens. Thank you so much for watching my video. And please comment on what you think of the Magnificent Seven stocks. Thank you.